So thank you all so much for your time and for prioritizing this economic update with Neerode and Paul. We're really excited to hear his updates on what's been happening in markets and our outlook moving forwards. So we are recording this. We will make it available after the fact, and we are also applying for CPD points as well. So we'll give you guys feedback on that in the next little while following the update. And then if you can please just ask that you keep yourselves on mute during the meeting, and then there is the chat that's open for any questions. So please, as we go along throughout the update, please pop your questions in the chat, and at the end of it, we're going to have a Q&A session. Over to Paul. Thanks so much for joining, everyone.
Great, thanks, Sarah, and thanks everyone for your time. I know you're all busy. Seems like winter's hit us with a vengeance. We were in a really hot summer just 2 weeks ago. Remember complaining about how hot it was. Now I'm complaining about how cold it is. But anyway, thanks very much for your time, and hope all's well on your side. And we're going to cover a lot today. I mean, I think there's a lot of uncertainty out there at the moment. I think that's the name of the game at the moment. And there's always uncertainty in the future, but it seems like it's just sort of been amplified lately. So there's a lot, I think there's a lot of anxiety going on out there. So, I mean, if you look at, interest rates are pretty much multi-decade highs globally. You've got a whole multitude of elections happening this year with what seems to be quite big consequences both here and abroad. More so here than abroad, actually. I think a lot of the noise on the overseas elections is overhyped, but definitely here there's big consequences to elections. We've got local markets that have kind of been floundering for a while now. They had a really good run up to a few years ago and have really been floundering over the last year. But with that, coupled with that, you've got these offshore developed markets that are just flying, seem to be unstoppable. So there's a lot of anxiety around that, is what's going to happen with those markets. So there's a lot going on, and hopefully we can address all of that today. Just to put things into context and kind of where we sit, I just want to quickly just go through our multi-asset. Obviously, this is a multi-asset outlook. So we're gonna look at economics. We're gonna look at how we're constructing our portfolios to take advantage of all the uncertainty that is out there going forward. But just to kind of look back over the last year and just to give you some perspective over our funds, and if you look at our funds. Sorry, just waiting for this to, let's see here. There we go. If you look at our funds, so we had a really good year over the last year across the board, pretty much. If you look at low equity, so that's our stable fund. So what this shows you is all the funds in the category. That gray line is the top quartile within that category, and then the orange line is where we sit, and then that's the ranking. So if you look at stable in the low equity category, sitting 23rd out of 164 funds. Moderate is a little bit of a smaller category, sitting 16th out of 94. We obviously have our two high equity funds. We've got our enhanced opportunities fund that's really doing phenomenally well. And then managed, also not in the top quartile, but beating benchmark at the moment. It's a little bit of a different mandate. As you guys know, we've got a slightly more aggressive high equity fund and a slightly less aggressive high equity fund. And then global flexible doing really well as well, 5 out of 43 there. So just going in terms of our rankings, we've done really well. And just looking at the backdrop, what's important to understand is the backdrop. How did that happen? So what kind of market took place in order for us to be able to do that? And if you look at what the all-share did over the last year, so over this time period that I've just shown you that performance record, the all-share did 1.5% over the year. So the all-share really going nowhere was actually, in fact, was quite volatile over the year. So a lot of people are kind of fixated on the all-share and focused on what's happening with the all-share. And you can see, I mean, at one point it was down 6% for the year, but really, if you look over the course of the year on a net basis, pretty flat, but quite volatile and quite noisy on how it got there. So not a great year if you look back for local equities at all. What I think the point that I'm trying to make here is that there are other ways to invest. There are other things to invest in, and when you're building portfolios, you have to look at your whole universe of assets that you have available to you in order to construct the best portfolios. So just going through our performance, as I say, we've got those really that really good performance. I mean, in light of all-share doing 1.5%, if you look at stable, we were still able to go and do 10.5% for the year over that time period, beating the benchmark quite significantly. And I think the important thing is, we haven't done that with stock picks. As you guys well know, we don't take active stock picks. Our local equity exposure is pretty much all very, very market cap neutral, market cap passive. And then our offshore equity exposure for the most part is also passive. We obviously do have our thematic tilts and our thematic bets around that, which I'll talk a little bit about later, but that's very limited in terms of what it gives you in terms of performance. And I'll quantify that a little bit later, as I said, but just to show you that you can, the main thing is getting your asset allocations right. It's getting your asset calls right. So you can go and do 10.5%, even, you know, when all shares going and doing nothing, by getting your asset allocation right. And that's what Neuro does really well. And that's our you know, reason for existing, essentially, is that we get that asset allocation call right and we construct our portfolios that way. So for us, it's always asset allocation first, and then how do you do allocations? Income and bonds slightly different, but on the equity side, definitely passive. So if you look at that, really excited to have done 10.5% and stable. If we look at moderate, same kind of numbers. So we're talking, you know, 11%, beating the benchmark quite significantly there. And as I said, all shares done 1.5% over this time period. Managed, little bit not as big of an outperformance, but still beating benchmark. If you look at enhanced opportunities, had a phenomenal year. This fund was only started in March 2023, so it's 13.5 months old now, and it's already beating benchmark by about 5%. So if you just look over the year, it's about 3.5%, but beating benchmark by about 5%. And then Global Flexible also having a phenomenal year. So obviously offshore did really well last year. And you know, that's one of the benefits of having this multi-asset outlook and looking at diversification, is because when one thing's not doing well, generally other things are running. And it's understanding how those asset classes move together and how they move together under different scenarios, and doing that scenario planning, doing that testing, and then coming up with your optimal portfolio that's going to give you the best probability of having a good outcome. And that's what Neurode's essentially about. So really good performance over the year. If you look at our thematic holdings that we hold, so we hold this in an enhanced opportunities fund, but then our stable, moderate, and managed fund of funds actually feed into that. So they get exposure to these themes via enhanced opportunities. You can see, so semiconductors done phenomenally well. And I mean, if you recall, a lot of market pundits saying it's not a year for semiconductors. You can obviously see the performance has been phenomenal. If you look at uranium and nuclear energy, that's a big call we've made. We've spoken about. Any of you familiar with our portfolios will know that we really like the uranium and nuclear energy theme. We think there's definitely a massive unwinding of some of this, what I'll just say, toxic energy policy that's going on in the developed market. And politicians, they are starting to become a lot more pragmatic around, you know, what really constitutes, or how you can really get to a sort of, let's call it, greener, stable energy band. Well, for us, you just look at sort of general tech, NASDAQ 100 also done phenomenally well. And then if you look at just the MSCI World, so these returns are all in rand. So MSCI World, just the market cap benchmark itself also done phenomenally well, but our thematics definitely adding a lot of alpha. That light gray line, which I'll talk a little bit about later, that's actually a new addition to the holding. It's the S&P 400 mid cap. So we like US. We favor the US. We think all the innovation is still within the US. We just think that there's more opportunity in the US. I mean, if you look, you want to be exposed to global markets, but the US is still about 60% of the global base and pretty much controls all the innovation. So any of your big companies, any company that's going to be launched that's worth anything at the moment, it's launching out of the US. And that's where you want to be. But we like the mid-cap space. It's looking a lot more cost effective. We'll talk about valuations and things just now, but that's a recent tilt. And actually, since we bought it about 6 weeks ago, it's actually been our best performers, that US mid-cap space. So mid-cap, a relative term there. So that would be the next 400 biggest stocks after the S&P 500. So it's from 501 to 900 essentially. But still, most of those stocks are bigger than what we have on our market locally. So still very big companies, but they're called mid caps in sort of US parlance. So yeah, so done really well. If you just in terms of the weighting of our tilt, so if we go back to enhanced opportunities, you know, that 3.6% outperformance over the year. If you look since inception, as I said, the fund's about 5%, beating benchmark by about 5%. About 1.5 to 1.6% of that is actually due to these thematic tilts. So it's very small in terms of the allocation. So that's the important thing to realize, is that This outperformance has really come from asset allocation, getting our asset allocation right. A little bit of alpha from the thematics, but predominantly it's the asset allocation. That's the important thing. So that's something we're really proud of, and that's also a lot more repeatable going forward. You know, you're taking on less tracking error, and you can, you know, you're not trying to pick your top 10 favorite stocks and hoping that they do all the work. It's really letting the asset allocation and letting our quants process do the work for us. And that's really shown. So you'll see generally our funds will do better in a choppy market. You know, if you have a sort of indiscriminate bull market where everything's going up, our portfolios will clearly do well through that process. But really where the value add comes in is in these choppy markets. It's these, you know, where the all share goes and does 1.5% over the last year. That's really where value shines through in terms of getting those asset allocations right. So yeah, getting into the economics and now looking forward, obviously that's looking back and looking forward and saying, okay, well, where do we go? And like I said, I put this in with a bit of tongue in cheek, saying uncertainty ahead, because obviously the future is always uncertain, but it just seems like there's a lot of big sort of elements at play at the moment. As I said, we've got interest rates at multi-decade highs. We've got elections, we've got all that. So looking at interest rates, and I think what's still on a lot of people's mind is, you know, what are interest rates going to do? And what's that going to do to, what's inflation going to do? What's that going to do to interest rates? And what's that going to do to markets ultimately? You know, we've had specifically global markets just flying, specifically the US, it's almost seems like it's unstoppable. And, you know, when's this party coming to an end, essentially? And if you look at what, you know, central bank ministers are saying around the world, it's still very much a hawkish undertone. So when I say hawkish, meaning still very much, they don't see rates coming down anytime soon. And I tend to agree with them. I do think that, you know, the market's still pricing in an interest rate cut at the end of this year, September. I'm not so convinced that that's going to happen. So I suppose that you can say is the negative news. The positive news actually is that I don't think it actually matters either. And I'll talk about that, the reasons why I think that as well. So if you look at the, you know, you look at the FOMC in the US saying, you know, very hawkish stance. We're not going to bring down rates until we've hit our 2% target. Bank of England, same kind of rhetoric. If you look at the South African Reserve Bank, obviously, you know, we've got to take into account that what the developed market's doing, but also not really, you know, our inflation has ticked up a little bit. We're still within our bands, but ticked up slightly. Now, our inflation is less control. We control our inflation less than what we think. We actually import a lot of our inflation. But really, what we're going to do is depending on what the developed market's going to do. And the developed markets doesn't seem like they're bringing rates down yet. European Central Bank, exactly the same thing. So much more hawkish tones, and these are all these little quotes we've taken from the last meetings that they had. So these are the most up-to-date sort of, let's call it narrative or thought process behind these monetary policy committees. And there's a reason. I mean, if you say, you know, the US is targeting at 2%, if you look, this is US inflation over the last while. You can see, so headline inflation being the orange line and core inflation being the black line. The difference between the two is that the core inflation cuts out food and energy prices. And the reason it does that is because food and energy is quite volatile. It's quite cyclical. It's commoditized. So it gives you an idea, a sort of less cyclical idea of what's happening in interest rates. So you can see it moves a little bit less than what's happening. So that is still trending down quite nicely, but you can definitely see starting to flatten out, and you can see headline inflation is kind of flattened out at around 3.5%. 2% down here, so it's still very far off their target. So, you know, I think the market's getting a little bit excited about these rates coming down, but you're not seeing it. You know, if you listen to what the banks are saying and you just take them on what they're targeting, what their word is, they want it to be down here. So they're only going to start lowering rates when inflation gets to 2%. So what's causing, you know, US inflation to kind of sit sticky around this 3.5%? So you can see it's come way off where it was. I mean, this is post-COVID with all that money printing. But you can see it's still a lot higher than the 2%. Now, you can argue and say, well, is the 2% target a realistic target? It seems to be quite arbitrary. You know, it's generally, I mean, if you look at South Africa, we have a target range of 3 to 6%, which is actually more pragmatic, because like, you give yourself a range with which to play in. You know, you're never going to pinpoint and control it exactly. But to say, you know, to target 2%, you could argue that's fairly arbitrary. But at the end of the day, that is what the target is. And that is what they're aiming for, whether you agree with it or not. So what's causing this inflation to be a little bit higher? So if we break down US inflation, this was the last print. So as I said, you know, 3.5% there, that's everything. The large, so you got a little bit of sort of general services here, which I suppose would come from wage growth, but the large majority of your inflation is still shelter. So that's a combination of house prices, rent, and a thing called owner's equivalent rent, which is actually quite a big proportion of that shelter. Owner's equivalent rent is essentially they go and phone up a whole bunch of citizens and they say, who are renting, and they say, what do you think you're going to increase rent by over the next year? And they say, oh, I think I'm going to increase it by 5%, and they write all that down. And if it averages 5%, they put that in. So it's not actually a real number in terms of an actual cost to Americans, to the American consumer, but it's a sort of hypothesized cost, if that makes sense. It's almost like a forward-looking cost. And that's a bit of a lagging indicator. So generally what happens is as shelter starts to come off, that will follow it later. So this is what we're waiting for. So I don't see, so this is definitely, and if you look at house prices, if you look at the shelter component and you just carve that out, this is what the shelter inflation has done. So it's definitely had its peak, but it's still quite significantly higher than its long run average. It's sitting at about 6%. So shelter inflation is sitting at about 6%. Sorry, just getting this light back on. Which is about double its long run average of 3%. So that 6% in shelter contributes to this 2%. It's about a third of the basket. So that's why it's about 2% of the inflation number. So as that starts to come down, if that starts to hit your 3% again, you can take 3% of what we are, a third, you're taking off about 1% off inflation. So that 3% becomes 2.5%, which is a lot closer to the target rate. But it's still going to take some time to get there. And I don't think that's going to happen before the end of the year. So we do still think, we think we're at the top. We don't think you're going to see rate hikes from here, unless you see a sort of unprecedented kind of turn in inflation. But we don't think that's going to happen. But we do think it's going to be longer for it to get to that 2%. And that's why we don't think rates are going to come down this year at all. So we think the market's maybe a little bit ahead of itself there. The market originally was thinking July, and then after the last meeting, now it's thinking September. It keeps getting pushed out. And I don't think you'll, so don't hold your breath for a rate cut this year. But definitely next year, if this number starts to come down, we do think you're going to start seeing those cuts. Why do we think it doesn't matter? Okay, so, if you say, well, the market's, hoping for rate cuts, if they don't come, why would that not matter? We do think in the short term, you'll see maybe some jitters and you always get that volatility. But over the medium term, it's because the economy is still very strong. So if you think, why are rates so high? Well, rates are high because the economy is actually really strong. The economy just keeps coming out. It keeps beating expectations. And that's something you can't discount. Because it is, at the end of the day, what equities and what share markets want is they want earnings. And where do earnings come from? Earnings come from economic growth. So if you just look at US GDP, it's definitely on, you can see it's cyclical. That's very seasonal, but you can see it's definitely on an upward trajectory. We're kind of in a seasonal dip at the moment, but then it then returns, but also beating expectations. So the red lines are the blue is what's expected at that print, and the red line is the actual number that comes out. So it doesn't look like a big beat, but even 10 basis points, 20 basis points is a big beat when it comes to, the largest economy in the world and in terms of the economic growth. If you look at non-farm payrolls, so actual jobs that are getting created, the market keeps expecting this to fall off. Well, when I say fall off, it's still, the long run is about 200,000 jobs a year. That's a healthy US market, is to be, 200,000 jobs a quarter. If the US market can add 200,000 jobs a quarter, just on a side note, it shows you how big that economy is. I mean, imagine South Africa could add 200,000 jobs every quarter at its sort of baseline. But that's what it keeps predicting. But the actual jobs that are getting added are 75 to 100,000 more than that. So even the last jobs number was close to 300,000 new jobs coming into the market, as opposed to 200,000 being expected. That's fantastic, because what that is more people working, more people earning, more people spending. And that translates into this GDP number as well. So these numbers we watch fairly closely. Another reason why I don't think it matters that interest rate reductions get pushed out is that the market's actually, so although it's a little bit, it's expecting a rate cut at the end of this year. So these blue dots are the Federal Open Market Committee. That's the committee that determines interest rates overseas. So that's headed by Jerome Powell. Those blue lines are where does the majority of the committee think rates are going to go. And that generally is so it's a dot plot. It generally is a good indication, because it shows you, when they all vote, they all go and vote, and they take the most votes, and the most votes at the end of the day wins, and that's where rates are. So where do all the committee members think rates are going to be in 2026? they think they're going to be down here. That's the so you can see that I think they're going to be just above 3%. Futures are pricing it. So what the market's pricing is actually this orange line. So the orange line is actually a lot more hawkish than what the monetary or the Federal Open Market Committee thinks rates are going to do themselves. So now I do think that the Open Market Committee is gone ahead of itself. I don't think rates are going to come down as quickly as they think, particularly this year. Potentially 2020, 2025, and 2026, you could see rates coming down this quickly. But for now, you can see the market's actually pricing in slightly higher than what the Open Market Committee is saying. So the market is actually saying, to an extent, we don't believe what you're saying. We think that rates are going to stay high for longer. So we think a lot of the pricing is actually in the market in terms of where rates are going to go. So don't feel too anxious. If you don't see rates coming down in the second half of the year, don't feel too anxious about it. It does seem to be that the futures market particularly is quite well aware of this. And as I say, until you're seeing this inflation number come down to 2%, don't hold your breath on rates coming down. If the FOMC is to be believed in terms of what they say in their notes. So yeah. One thing that we are finding, it's not a huge red light and big concern for us at the moment, but it's something we're watching. And if you had to say, what's a number that you would watch closely over the next year, particularly with elevated rates, is the money growth, is the money supply in the US. So this orange line is US money supply. The black line is the US Fed total assets. So you can see as the Fed has been buying up assets, buying up US treasuries. So this was the GFC, and then this was COVID. You can see these massive purchases. You can see how COVID just dwarfed the GFC. But they're buying up these treasuries, and then what they do is, as they buy the treasuries, they're injecting all this money into the market. So that all this money flows into the market and into the economy, and that then translates into money growth, and then obviously the money growth translates into economic growth. So if you're a monetarist and you kind of believe that Milton Friedman believe in sort of his economic philosophy, you want to focus on this number quite extensively, because money supply ultimately determines economic growth. So if you have money supply coming in, you've got good growth. If you have money supply coming out, that can have an effect on growth. So you can see money supply started to roll over as the Fed has started to dwindle its balance sheet. So you can see this was the all-time high assets. So now what the Fed has started to do is they've started to sell treasuries back into the market and take cash out. So as they buy the treasuries, as they sell the treasuries, they're taking cash out of the market and putting the treasuries back into the markets, putting assets back into the market rather than money. Okay, that's a way to kind of restrict. So they've been doing this along with raising rates. So they've been using, let's call it monetary policy, as well as, they're both monetary policy, but using interest rate policy as well as Fed purchases and sales to manipulate the money supply. So if you translate that into a growth, you can see money supply growth. So this is now this, but in terms of a growth rate, you can see how Fed assets, and you can see how money supply has grown along with this. You can see money supply during COVID was just massive because they also had there was also a fiscal impulse. It wasn't just a money impulse. They were also paying people. They were essentially giving people paychecks to go out and spend money. So it was both a monetary and a fiscal stimulus that was going into the market. And you can see that the money supply growth, if you look on the left-hand side, sitting at 30% year on year at the high point during COVID. So you're putting 30% extra money into the economy. No wonder that, markets took off and the economy was very strong. But what you started to see, and we haven't seen this for a very long time, is you're starting to see money supply growth go negative. Okay, now at the moment, we're not too worried about it because you can see that there was a massive impulse here. So there's a long run money supply growth of maybe 5%. But you can see what COVID did. So a lot of this, negative, it still needs to undo this. Okay. And that's what we need to watch. But you can't run negative money supply growth. You can't be pulling money out of the economy for too long. Okay. So that's something that we need to watch. So there's a couple of ways that they can start putting money back into the system. One is to bring down rates. Another one is to stop their asset sales. Okay. So now I think they're still going to probably keep asset sales going for a while. But at some point, we're going to want to start seeing those rates coming down. because that essentially will turn this money supply growth into positive territory. So you want to see this positive. So right now they've really got a handbrake on money supply. It hasn't really translated into the economics yet. As I say, economic growth has still been really positive. Jobs are still coming on in crazy numbers. But it's because of all this this buffer here that you've got all this excess money that was put into the system here, both fiscally, from a fiscal point of view and a monetary point of view. So this we're watching. So you don't want this to sit negative for too long. But even if it's another year and a half, we still think that that's fine. I mean, you can see just the scale of the growth here that needs to be offset. So if you had seen, you know, a normal kind of money supply growth and then a negative here, you know, that's a lot more cause for concern than what we're seeing right now. But it is something we're watching, and that if you had to say what's the one thing that you should be watching, it's really that money supply growth. Everything else is a derivative of that. Okay. If we get into so we think, you know, ultimately don't expect rates to come down this year, both locally and globally. You know, we'll follow exactly what happens globally. But it's not necessarily a problem yet, but it's something we do need to watch. So, but we do still think that there's a lot of excess, there's a lot of wealth out there, there's a lot of growth, there's a lot of demand still. So to take that into account, I think is important. If you look at Switzerland, so maybe some of you would have known, Switzerland has actually already reduced rates by 25 basis points. So we had a lot of questions, you know, well, you know, if Switzerland, let's say, was the first to pull the trigger, when are the rest of the developed markets going to start cutting rates? And we don't think they're going to pay much attention to Switzerland. You can see, so that black line is the Swiss inflation rate. The orange line is the US inflation rate, the dotted line. And then the solid lines are the policy rates. You can see Switzerland has much lower inflation, and actually inflation has come down. It's sitting at about 1% at the moment. So they are in a space to cut. So they are the first developed market to actually cut into the cycle, but we don't think necessarily you're going to see the rest of the market following them just yet. Inflation still quite a lot raised from here, or specifically from the 2% for like the US and Europe and things like that. So just something to keep an eye on. But we did have a lot of questions around that. Okay, getting into South Africa. So South Africa, we're still inflation sitting between the bands, 3 and 6%. It's sitting at about 5.4% at the moment. You can see it come off and it's kind of flattened up. You could call that a little bit of a tick up. But you know, as I say, we don't control most of our inflation. So a lot of our inflation is actually imported. So if you break it down, the 5.6%, the last print, this is what sort of makes that up. You can see a lot of it is still miscellaneous goods and services. A lot of that, like electronic goods, things that are, you know, phones, things that are imported. If you look at transport, petrol price is a big one. So if you look at the weakness of the rand, you know, that's going to come into there. Housing and utilities, so that would be where Eskom falls in. I mean, obviously Eskom bringing out massive increases in terms of electricity supply, so that comes in there. And then food and non-alcoholic beverages, that's more of a local phenomena. We do have raised there. I mean, we've had it's hard to think about it now, but we actually had a drought over this last harvesting season. So it has had quite an impact on maize and wheat prices. So that does come into, you know, and then obviously a knock on to your poultry and your meats and things like that. So not huge, but that's where you get how you get to the 5.6%. So still very much within the bands, but a lot of it is not, you know, a lot of it's imported. So when you start to see inflation coming down overseas, you start to see rates coming down over there, then we have more flexibility to bring down rates as well. But we're not going to bring down rates on our own, trying to sort of lead the charge in terms of what offshore does. Well, it's highly unlikely that we would do that, especially considering we're sitting sort of at the top of our band right now. Maybe if we were sitting at 3%, you would see it, but not at the moment. And then also the currency protection is an important one. Obviously, the currency it hasn't actually been that weak over the year, but definitely, let's say the dollar's been very strong. So the rand dollar's off quite a bit, and they want to protect that currency movement as well. So that's, you know, another sort of element that our monetary policy committee needs to take into account. So if we look at valuations, you know, so I've said, you know, talking about where the markets are, we think we're at the top of the cycle, although we think that the cycle, when the cycle starts coming down, it's going to be a little bit later than what most people are thinking right now. But what about valuations? You know, should we not worry about valuations? Have US stocks not run really hard? They have run really hard. They aren't bad. Earnings are still coming through quite strongly. So if you look at this is just forward PE ratios, just very simple valuation metric. So if you look at that blue line is the all country world PE. The purple line is the US stocks. The red line is Europe, the Far East and Asia, and then the green line is emerging markets. So you say to us, okay, well, American stocks are looking cheap. But there's two ways that you can get yourself out of a high PE. The one is you get a re-rating in price, and the one is you get a re-rating in earnings. So if earnings still come through and are really strong, you're going to see that automatically coming down even with no re-rating in price. And that's what you're seeing in the markets. And that's why the US market is commanding such a premium at the moment. You go and say, well, emerging markets are cheap. Why not buy them? Well, there's no earnings either. That's the problem. So, the US market is kind of earning itself into a better situation. And we monitor that quite closely. So if you look at last quarter's earnings, we monitor this. So we have a system that we developed in-house that kind of filters through all the earnings and pulls through. So all these little dots are companies that are on the S&P 500. And the right-hand side is companies on the NASDAQ 100. And the bigger the dot, the bigger the company. So that, for example, would most likely be Amazon, something like that. Microsoft, you can see the sort of big stocks in the S&P 500 here. And then what we do is we say on the y-axis, it's the actual earnings. And on the x-axis, it's the estimate of earnings. So what are analysts expecting earnings to come up? And anything to the right, so above that 45-degree line would be earnings beat, and anything below that would be an earnings miss, essentially. And we monitor that quite closely. And if you look at that, it's hard to get all the stocks through an earnings cycle because they actually rotate. It's not like there's one season of 2 weeks and then another one. So they kind of rotate through the quarters. But if you can see the last time we did this in Q4, you can see that at the time, most of the US stocks had reported, and the actual average earnings beat on a market cap basis was 7%. So what the market thought earnings would be versus what the earnings actually was, it was a 7% beat. So these earnings are already elevated. These are already taken into account growth, but then you had an additional 7% above that on an annualized basis, what actually came out. And then if you look at the NASDAQ, a very similar thing. So earnings continue to just they continue to beat what the consensus is, essentially. If you look at just break that down and look at through the sectors, it was pretty much through the sectors. So you can see 76% of companies beat earnings, 19% missed earnings. But if you look through the sectors, also pretty much across the board, you're getting beats. So it's not specific to one sector. It's not like tech or whatever. It's across the whole board. And that's quite positive, and it shows you quite a buoyant market and quite a buoyant economy. If you look at now, we're actually running through an earnings cycle at the moment. So it's the first quarter. So this was up to yesterday. So first quarter of 2024, and you can see massive earnings beats. So you can see this is okay. Not a lot of companies have reported yet, but you can see we're about 13% ahead of earnings on the S&P 500 and about 25% ahead of expected earnings on the NASDAQ. Still very early days in terms of the earnings cycle, but just to show you that these earnings keep coming in. So right now, if you look at the picture and you take a snapshot right now, you've got US stocks that are looking on the face of it quite expensive, but if you keep seeing these earnings beats coming out, they'll re-rate and get cheaper just purely from earnings, outsized earnings. But you always want to hedge that. So you want to make sure, because the party can end at some point. So you've got that, then you've got on the back of that, you've got the interest rates. So currently interest rates are not affecting the economy at all. And that's because of all that money that was pumped into the system. So that's starting to be taken out of the system now. So those are the dynamics we've got to watch. Is as that money gets taken out of the system, what's going to happen to rates? Or rates going to come down? And then what's that going to do to this really, really strong and robust economy that we're seeing out of the US? So those are the kind of dynamics we at play. It's very hard to predict how that's all going to fold out, but those are the things we're watching. And obviously what you want to do when you're constructing the portfolio, which I'll talk a little bit about now, is you want to set yourself up to make money in good times. So you don't want to stop, you don't want to say, well, what if, and then you don't take the opportunity. So you want to set yourself up to make the money, but you want to hedge yourself really cleverly. So just looking at one of the things we've done in the market, I mean, if you look at the Magnificent Seven, it's still driving earnings. So just to give you an idea, in the S&P 500 this year, the market is expecting, well, in this first quarter, the market is expecting earnings growth to be 3.8% annualized on the S&P 500 as a group. On the Magnificent Seven, so that's your mega cap large, your top seven, your top seven sort of large cap tech stocks, that earnings expectation is 38% earnings growth this year. So you say, okay, well, tech is still doing well, is that not analogous to what was happening in 2001 and, in the dot-com bubble? And no, it's not, because in 2001, there were no earnings. It was all speculation. Now you're actually seeing a lot of earnings coming out of these companies. So, I mean, you can imagine. So that top 7 as a basket of stocks is going to have projected, it's probably going to beat this number, but it's projected to have 38% annualized growth in earnings this year in the first quarter from last year, as opposed to 3.8% from the S&P 500. So it shows you, so it just shows you that kind of difference. But so you want to kind of still take advantage of that, but you want to hedge yourself as well. And that's one of the reasons we bought the mid caps. So we've taken a position in the mid caps. So kind of to offset because we still like semiconductors, we still like tech in general, we still own it, but to just kind of hedge that a little bit. So what you can see here is this is the large cap forward PE, and you can see the mid and small cap forward PE being a lot lower. So this is above average. And as I say, we think still justified because earnings are coming through at a massive pace. But then on small and mid cap, actually below average. So we've taken a mid cap position. So we've bought some exposure to the US mid cap space. A lot more, if you just look purely at valuations, a lot more valuations, a lot more value in terms of PE. If you're just going to use a static valuation model, but it's a good hedge for us on, you don't want to be too exposed and overexposed to just the things that are flying, although we still think they're going to do very well. So if we look at our expectations on our themes, so if we look at semiconductors, firstly, they are expensive from a PE valuation. So what we do here is we say, okay, on a 5-year view, so this is our modeling in terms of a 5-year lookout, okay? So over 5 years, assume that semiconductors go back to their average PE, and then just assume the growth rate. So assume the market is assuming the average analyst out there has an earnings expectation. So take that earnings expectation, say if the semiconductor industry gets that earnings expectation and then just re-rates to a normalized PE 5 years from now, what does the actual semiconductor market do? So you can see on a re-rating point of view, it actually loses. So because it is slightly higher in terms of its valuation relative to history where it's been. But if you look at the earnings growth, so the black is the re-rating, the light blue is the earnings growth. And then if you net the two out, that's our projected annualized 5-year return. So even from here with semiconductors, we're still projecting above 20% return in earnings through this market going forward, and a return on investment through this market going forward. If you look at using the same model for the S&P 500, it's sitting at about 9.4% annualized, still very good return. This is in US dollars. The MSCI World sitting about 9.2%. Emerging markets, we've got a tilt on sitting at about 17.7%, but still thematics. Semiconductors sitting around here. If we look at the same for general tech also still looking quite superior to what we think you'll get out of general sort of world equities. And then this mid-cap 400, not as racy as semiconductors and general tech, but still sitting at a good, healthy 14% expected return on investment over the next 5 years. So yeah, still quite well ahead of the large cap stock. So we still like the US. We still think you're going to get a decent return long-term out of it, but definitely taking our tilts in terms of the mid-caps, tech, semiconductors and things like that. So even though these things have run really hard from a valuation point of view, they're actually still not looking that expensive. If we look at elections, I got the team to, when we were sort of deciding what to talk about in this update, the two big things were, one is interest rates and inflation, what's happening over there, and the other one was the elections. And massive, I think, changes ahead would be the slogan of the day, particularly in South Africa. We've had a sort of, for the last 30 years, we've had a specific sort of framework and structure around what's happening in our local politics, and I do think that's ready for a massive shakeup on the 29th of May. And if you look at the pollings, so it's quite interesting. I mean, a couple caveats on pollings, or a couple things are just they're not forecasts. Sorry, just the light keeps going off here for some reason. They're not forecasts. So remember, poll is a snapshot in time. So what it's saying is, if you ask everyone now what they think, who they would vote for, that's a snapshot in time. And that changes over time, and it can change on many factors. It can change on, what campaigning the underlying parties are doing. So generally what you'll see with the ANC is the ANC will always do better than the polls coming up into an election, because they're very good at rallying people You know, they put about 1 million people on the ground before an election in terms of campaigning and getting people out there. And that'll always help them get an extra 2 or 3% that they probably wouldn't have gotten just if you just run a poll number, for example. So things like that. But what it does, but what the polls do clearly show is you can see trends. So we got the last Social Research Foundation poll in April 2024. If you ask me, you know, which polling should you look at? There's many different polling sources in the country. I think the methodology around the Social Research Foundation polls is probably, I would consider to be the superior methodology. What they do is they look at a very diverse demographic, very representative demographic, and they don't just ask them to or who they're going to vote for. They actually do a whole survey on each of the individual voters, and I'll go through some of those answers now. It's quite interesting. But definitely in terms of that, their polls are quite big and they have fairly low margins of error. So a poll like the SRF poll, that's got a margin of error of just over 2%. So what that means is if the ANC polls here, which it's sitting at about 37%, that's anywhere from 39 to 35%. But anyway, the numbers are less important than the trends. So you can see the ANC since 2022, you can see all the different polls coming out. You can see there's definitely a downward trend. DA is actually stayed fairly flat at around the mid-20s. If you look at the EFF, also kind of flat, kind of not really growing, sort of just above 10%, pretty much where it was in the last general election. IFP kind of also staying fairly flat. And then obviously this MK party, you know, the new Mkhonto weSizwe party, Zuma's party, as they're calling it, definitely shaking things up in the last few polls. Now, as I say, this isn't necessarily a predictor of what's going to happen in the elections, because I do think there's probably a lot of excitement around the MK party. You'll probably see that come down a little bit as people get used to the idea. You know, there's always a hype on these things in the beginning, although I do think they are going to take a fair bit of market share. And then, as I said, the ANC generally can rally quite well towards the, you know, as the elections start. So you'll probably pick up here. But if you just look at the average of the polls, you know, over the last 2 years, these are the numbers you're seeing. So you're seeing ANC sitting at around 45. So if you look at the last poll, it was sitting as low as 37. But just if you average these out, sitting at about 45, the DA sitting at about 25, EFF sitting at about 11, 12, IFP, and then MK obviously coming out as the sort of big surprise here. And then all the other rats and mice parties. So the big thing around this is not the numbers themselves. The big thing around this is what it's going to do in practice after the election's been held. Now, if you'd asked me before MK party had been created, you know, is ANC going to get below 50? I think it would have been touch and go. I think that probably would have been able to eke out maybe a small majority. And if they went under the 50, maybe a 48, 49%, which would have enabled them to go to one of these smaller parties, do form a coalition, give these smaller party leaders, you know, a seat in parliament, or make them a minister of something, do something like that, and they would have been fine, carried on as normal. What's happening now is with this MK party coming out, it's definitely going to eat. It's definitely hurt the ANC voter base or the ANC support. And I think what's going to happen now is you know, if you look, I mean, at 37%. Now let's assume this poll's a little bit aggressive on this 37%. I think ANC is going to sit somewhere between this 37 and this 45. So let's say they come at around 40, 41, 42. Let's say they rally a bit towards the elections, get another 2 or 3%. Let's say they finish at 42, 43%. They're not going to be able to go to this base here, because, you know, there's a lot of parties that don't agree with them, that have very different ideologies to them in this base as well. They're not going to be able to go here. They're going to be forced to go to one of these big four parties over here. I don't think the IFP is big enough for them to be able to form a coalition. So really, you got three options. You got DA, EFF, and MK. And that's, I suppose, where the change comes in, is which one do they pick? And that's, I suppose, the real challenge around this election, and the real uncertainty around this election is which coalition partner, because I believe it's going to have to be one of those big three, is the one that they're going to pick. And that's really the uncertainty. And to predict that is virtually impossible. You know, you could argue that there are reasons to pick and not pick certain parties. You know, one reason not to pick the EFF or MK, for example, is that they share the same voter base. So essentially what you're doing is you're diluting your value add to your own enemies that you're sharing a voter base with. What does that do to all three parties at the 2029 election? So, you know, things like that they'd have to think about. If you go with a DA, Are you also, I mean, although you're not sharing a voter base with them, are you not being perceived to be selling out in terms of ideology and things like that? So there's a lot of demographics. But if you look at what the voter thinks, and that's why I like the Social Research Foundation polls, they ask other questions. If you look at what the average voter thinks, so the voter was asked, so these 1,500 people that were polled, they were asked, if the ANC has to get into a coalition, who would be the preferred coalition partner in your eyes? And you can see the majority was actually an ANC-DA coalition, but very close second was an ANC-EFF coalition. So if you look at the voter base, and this is what the ANC is going to have to look at, is what it's at the end of that, it's going to have to provide it's going to have to give the voters to an extent of what they want as well. You can see MK didn't actually do very well, IFP didn't do very well, but it's really amongst the EFF and the DA. So you got kind of half the voters saying, or 50% out of those two outcomes saying rather move more left. So if you got the ANC here, well, let's rather move more left, and the other saying rather go more center, go to the DA. So it's quite polarized in terms of what you're seeing there. So these are the kind of things that the ANC is going to have to think about. And that's why there's so much uncertainty. It's almost a coin toss between the two. And I think those are probably the two highest likely candidates to form a coalition with the ANC. So it'll be very interesting to see what happens. But, again, a lot of uncertainty around this. And how do we as managers build that into our portfolio construction? And I'll talk about that a little bit later. But another question would be they had here, so in terms of ideology, so the first question was, would you rather the government had a two-tier healthcare system, so you could still have private funded healthcare, or only government healthcare? And the second question, only government. The government should be involved with healthcare. So again, an ideological question. And you can see that the first statement actually came out the strongest, but strongly agree with the second statement was not far behind. So again, you're seeing this very polarized. So it's either do you go more left, or do you go more left, or do you go more right? So it's, again, very polarized. If we look at another question, so in terms of foreign policy, the first one would be, would you rather the government aligned with, Saudi Arabia, China, and Russia, or would you rather the government aligned with the West? So again, the majority of voters actually would rather the government align with the West, but you've got a very close second by the majority of the governments aligning with those other, let's call it non-Western friendly governments. Again, there's a lot of polarization. And then the last question, which I find quite interesting, was, would you rather your government put the citizens of South Africa first, or would you rather they put their ideology first when it comes to foreign policy? And by quite a big margin was, most voters want, which is obvious, was want the government to forget about ideology. So move away from ideology. The most important thing is you put when it comes to foreign policy, is put the South African citizen first. When you work out when you're determining foreign policy and who to align with, which benefits SA citizens the most, and that's more important than the ideology and the loyalty to your ideology in terms of global foreign policy. So that's quite interesting as well. So ultimately, a lot of uncertainty here, and I'll talk about how we think about that a little bit later. If we go into the international markets, it's highly likely, if you look at current polls, that actually Trump's going to win this election. Things can change, and you can see the polls trending. So Biden kind of ahead of Trump, until sort of third quarter of last year, but Trump's starting to overtake. And this poll's quite interesting. What they do is they take all these pollings and they say the margin of error on this poll is 3%. So they say if the polling falls within that 3% margin of error, what they did here is they actually gave that to Biden. So they said, let's say the state of Nevada has, or let's say the state of New York has Trump at 51 and Biden at 49, give it to Biden because it's in the 3% error. And then they had a neutral one saying, okay, well, we'll rather keep it with Trump then. So they have a Biden, let's call it favored outcome, where Biden wins everything that's within the margin of error. And then they have a neutral outcome where just even though it's within a margin of error, if Trump wins, give it to Trump. If Biden wins, give it to Biden. And you can see on the neutral, Trump wins by quite a heavy margin, but on the Biden favored, where he gets everything in the margin of error, Trump still wins actually in terms of the electoral college. So currently, if you look at it, and forget about what the media is saying, but currently, if you look at it on the polling numbers that are coming out, Trump is polling very well, very strongly at the moment, with the average citizen on the ground. So that just shows you. And what does that do to global geopolitics? I think it would have two big impacts. You know, if you look at it, still the Senate and the House governing the country. But if you look at it, I think we could have two big things. Is one in terms of corporate tax. So Trump could come in and he could issue a direct executive order to reduce corporate tax, which I think would be very positive for the economy. But number two is foreign policy. So I think Trump would probably be a lot stronger in terms of foreign policy as well. So particularly, I think in the Middle East, you know, you're seeing flare. Yeah, you just, you know, obviously Iran invading Israel, or not invading Israel, but bombing Israel, or attempting to bomb Israel. And I think you could see that cooling down. I think the globe, I think perceives Trump to be a stronger leader than Biden. So I think it'll be interesting to see what happens with global geopolitics there. But definitely you're seeing the swing in the developed market. If you look at the UK, you're seeing the reverse swing. So you're seeing kind of in the US, and this is kind of, you know, democracy working at its best, as you're seeing the US kind of moving very strictly, and you can see how unhappy they are with their leaders. If Democrats are in charge, generally then everyone's kind of swinging towards Republicans, and if Republicans are in charge, they're kind of swinging towards Democrats again. So you can see there's a big chop and change amongst the actual voter. So it looks very polarized at the media level, but if you actually look underlying, they move around a lot. Same thing happening in the UK. So you can see the UK, obviously, you know, just after Brexit, the Conservatives, the Tories are polling really well. Now the Tories have come right off, and you've seen the Labour Party pick up. Currently, obviously, Tories are in power or governing, and are you seeing kind of the whole electorate moving towards Labour Party? So you can see there's the sort of vacillation and the shift. Interesting to see here, though, in the polling on the UK, the Reform Party, which is even right, it's more right than even the Conservative Party, starting to gain a lot of traction there. So again, you're just seeing this kind of the voter base just showing a lot of unhappiness and a lot of distrust in terms of its own government, and just moving away. So you're seeing kind of the US shifting more left, the US shifting more right in its polling, and the UK shifting more left in its polling. So it's quite interesting. It's essentially just covering the opposite of what had happened in the previous 4 or 5 years. So it's interesting, but I don't think the UK and the US elections are going to have too much of an impact. I think big impact for us is actually our local elections, what's going to happen here. And that's obviously, there's a lot up for grabs. So, you know, I think with all this uncertainty, as I said, that's the name of the game, is what do you do with it, you know? And I think it's always pragmatic, is to focus on what you can control. And what we can control, and what Neuro does very well is is understanding our assets work together, understanding how they correlate, and then using our quantitative processes and what we've developed in-house to be able to build the best portfolios with the best probability of having a good outcome. I've seen over the last year, All-Share didn't do anything. It did 1.5%, but the funds were still able to perform really well. And it's because you need to understand how those asset classes work together. And a big thing for us, I think, with all this uncertainty that's going on there, and where we see a big opportunity in terms of hedging, a lot of our exposure from an asset allocation point of view is in offshore developed market bonds. So what this chart shows you is the orange is the local markets, the local All-Share, since around 2005. Shows you what it's done. It's done very well, actually. Yeah, it's had, I mean, that's the GFC, you had Nenegate here, you've got COVID here. And then overlaid onto that is this black line is US treasuries, specifically US long-term treasuries, so 10+ year treasuries in rands as well. And what has that done? And you can see actually done fairly well, not as well as equities. You wouldn't expect it to. It's US treasuries, but it's done fairly, it's still done at giving you about 10% in rands over this time period. And most of that actually was not due to yield. It was actually due to the weakening rand. But what we like about this asset class so much is look what happens in times of difficulty. So if you look at the GFC, the market comes off, the share market comes off. But what happens to these things in rands? They absolutely fly. Again, during Nenegate. So you have any sort of negative political outcome, you have these things coming in and saving the day. Again, in COVID-19, you can see the rand return. If you owned US 10-year treasuries, just before COVID, you were smiling in rand terms. I mean, it went from about 50 to 80. It was about a 60% return that you got. And then it starts to come down again. But in those times of shock, you want to see, you know, these things do really well. So what we've done in the portfolios is we have quite a bit of US, particularly offshore developed market, but particularly US long run treasuries. And those are designed to be those shock absorbers in negative times. So you still want to make money when times are good, but you want to be prepared for when those times are bad. And that's essentially what we're doing. So We still own our thematics offshore. We still own semiconductors. We still own tech. We like that space. But if there's a shock there, we're building this position in our offshore treasuries to be able to absorb that. And same locally, if there's a shock in the election, let's say it's a negative shock. Let's say you see an ANC, EFF kind of coalition, you're going to see a weakening in the rand. You want to expose yourself to those offshore assets, particularly offshore treasuries and things like that. So, but then again, you could get the positive shock. You could get the ANC DA. So you still want to have your offshore exposure, but you still want to have your local bond exposure and things like that. So it's how do you get all this together and how do you build it all together, statistically speaking? So if you look at our asset allocations, just quickly, you can see the bonds. So in stable at the moment, we only have 8% in local equity at the moment. As I say, there's other ways to get returns. Stable's got a CPI plus 3 mandate. Wants to do inflation plus 3. There's other ways to get returns than just through local equities. So it's only got 8% local equities at the moment. Almost got as much in offshore bonds. 5% in offshore bonds at the moment in this portfolio. Offshore at the moment sitting at 27%, which we think is on the high end offshore for a low equity type of kind of moderately conservative portfolio. Similar theme in moderate. Local equity sitting about 20%. Bonds sitting about 4%, so it's obviously a more aggressive portfolio. If we look at managed, bonds also sitting about 4% offshore. We've still got a lot of local bonds as well. And then offshore equity only sitting at, for a high equity fund, sitting at 36% on the local equity as a high equity fund. Enhanced opportunity, it's a little bit more of an aggressive high equity fund. We've still got our thematics, which you're going to get exposure to into the fund of funds as well. But sitting at about 40% in local equity. But still starting to build this bond position. And then global flexible, you can see 15% of our global fund at the moment is sitting in global bonds. And most of that is sitting in US treasuries. So just dedicated US treasuries, the safe haven asset of the world. We've got about 11.3% of this portfolio sitting in US treasuries at the moment. If you look at global equity, still fairly high in this portfolio. As I say, you still want to make money while you can, 75%, but we've got a nice buffer here. We also own a fair bit of property here, about just under 11% in property. We do think if rates start to come down, property is going to run really hard. So you want your exposure to property, but also if you get a shock in the system, that's probably going to do a little bit better than sort of like, tech would do, for example. So it's a bit of a hedge, but it's also kind of building into the rates coming down eventually. So global bonds, I'd say, and what we've done, we've spent a lot of work. So taking all this uncertainty into account, spent a lot of work on how do you still get the best probability of a good outcome. So you don't need the all shit to go and do well is the bottom line. And you can have those protections and you can get that exposure in different ways. So that's what we do. I think that's it for me. I've pretty much hit my time allocation, but if there are any questions, please feel free to shout. Obviously, if you do need to get going, you'll still get your full CPD points. But anyone who wants to hang around and ask any questions, more than happy to spend a couple of minutes on that as well.
Yeah, thanks everyone. You're welcome to pop your questions in the chat or also ask them, whichever you would prefer.
Are there any questions, Sarah, at the moment?
No, there are no questions in the chat at the moment.
Hello, Paul. Sorry, Estienne here. Just a quick question. It might even be irrelevant, but how would the Bitcoin halving affect any of the treasuries or anything like that? Or pretty irrelevant?
The correlations with treasuries, I think it's got a high correlation with gold, for example, gold commodities. So you're seeing sort of cryptos as almost an alternative sort of safe haven gold type play. So I think there would probably have more an effect than say US treasuries. I think what's driving Bitcoin at the moment is just the fact that US companies can now issue stock traded ETFs. So your average investor out there, as well as your average institutional investor, can go and buy cryptocurrencies through an exchange now, through the New York Stock Exchange that they weren't able to do a couple of months ago. And that's why you've seen Bitcoin particularly run so hard. How does that affect treasuries? I don't think it has much of an effect. I think they're different drivers. I think Bitcoin's still very much a speculative type play, whereas US treasuries are more a sort of investment type play. So guys are looking at US treasuries in long run portfolios and saying, okay, what can I get out of US treasuries as thing for example, what we're doing? How do I hedge my portfolio against risks, uncertainty, that kind of thing? Whereas Bitcoin's still very much it's still very, very high. There's a lot of volume. There's a lot of retail trade. It's still very sentiment driven. There's a lot of you know, guys trying to take advantage. You know, it's short term in nature. So kind of different dynamics driving the two. So I don't think the relation between the two is they don't really impact each other that much. If that makes sense.